Welcome to the Deep Dive, where we take a monumental body of knowledge, filter out the noise, and boil it down to the actionable insights you need to become better informed.
Today, we are opening up a really influential framework, one that has guided success for decades.
That's right. It's Jim Rohn's The 5 Major Pieces to the Life Puzzle.
But we're not just, talking philosophy here.
No.
We are running this entire framework through a financial lens. We're applying it specifically to your long-term investing strategy and sustainable growth.
And the reason this framework is so durable, even for finance, is its core premise. It suggests that sustained external success—
Like a great portfolio return.
Exactly.
Right.
Or achieving independence. It isn't about, say, external market timing or getting lucky on one stock. It requires internal refinement.
Ron's whole thing was that you have to fundamentally become more to attract more.
Yes, and that applies just as much to high-quality opportunities as it does to wealth.
Absolutely. So our mission today is to unpack these 5 interlocking elements: philosophy, attitude, activity, results, and lifestyle, and show how they form a disciplined, actionable, and self-correcting system for building lasting wealth.
We're moving past the motivational quotes and really getting into the behavioral finance of Ron's system.
Okay, but before we dive into the blocks, just a necessary word of context here.
Of course.
Our sources for this deep dive are grounded in real-world investment principles. We're talking academic research, a bachelor's in financial economics, and about 25 years of hands-on experience.
But, and this is important,
This material is designed purely for informational and educational purposes. It is not and should not be seen as financial, tax, or investment advice.
every financial situation is unique.
It is. So you must consult qualified, registered advisors for personalized guidance before making any investment or financial decisions.
That's critical context.
Yeah.
Okay, let's unpack this journey. Let's start with the foundation, the chief cornerstone of the entire system. Pillar 1, philosophy.
Philosophy is the set of your sail. That's the analogy. It determines the direction you travel, regardless of how intensely the market wind is blowing.
So it's your core beliefs.
It's the set of beliefs and convictions that forms your framework for making decisions. And in investing, this is, it's literally your compass.
I love that sail analogy because, the market might be throwing storms or just unexpected calms at you.
All the time.
But your philosophy, your deep-seated belief system, that's what keeps the portfolio on course. But let's get specific for you, the investor. What does an investment philosophy actually look like?
Well, it translates directly into your investment policy statement, or your IPS. It's answering those fundamental questions.
Like, who am I as an investor?
Right. Are you a value investor focused on intrinsic worth and ignoring daily volatility? Are you a growth investor betting on future innovation? Or are you a strict indexer? Your philosophy is that commitment. It provides the filter that helps you ignore all the noise from financial media.
That makes sense. That structural rigor. But isn't there a risk of it being, too rigid?
That's a great question.
If your philosophy is too fixed, don't you risk missing huge shifts, like the emergence of AI or the collapse of an industry?
It's an excellent challenge. Ron's philosophy isn't meant to be static, it's meant to be foundational. The source really emphasizes that philosophy is learned from success, but
More importantly, from failure.
most importantly from failure. If the market is telling you your core thesis is consistently wrong over a long period, you are ethically and financially obligated to refine that sail.
So it's an iterative process.
Exactly. You don't abandon the ship, you just adjust the rudder based on what you've learned.
So the investor has to be the architect. That's how the source describes it. You have to see the final structure first.
Yes, you have to see it in your mind.
Whether it's early financial independence, a specific passive income stream, or, just passing on capital, and then you build it block by block.
Exactly. You visualize the portfolio yield, the total return you need, and then you start acquiring the materials stock by stock, ETF by ETF. If an architect only focused on the current price of lumber, the house would never get built.
That's a great point. That commitment to the blueprint, the philosophy, it creates the basis for wise decisions. You stop reacting. You start executing a vision.
And that commitment, it transitions perfectly into pillar 2, attitude.
Right. If philosophy is the intellectual blueprint, then attitude is kind of the emotional control panel, is how we respond.
This is where most investors fail. It doesn't matter how smart they are. A downturn doesn't just test your portfolio, it tests your attitude.
So panic selling, FOMO during a bubble.
Or just letting inertia prevent you from rebalancing. These are all failures of attitude. Attitude is about having a positive outlook in maintaining the framework, seeing the future, and stopping those emotional reactions that sabotage your own goals.
Okay, but how do we draw the line between a healthy reevaluation, which we just talked about, and a destructive emotional panic reaction?
The differentiator is time horizon and evidence. A philosophical refinement takes weeks of analysis. An attitude failure happens in 10 minutes when you see a scary headline and just click sell. A strong attitude encourages using past market experiences as a kind of school.
So you use the 2008 crash or the dot-com bubble,
Yeah.
not as sources of terror, but as lessons.
As lessons in volatility management, it's that Stoic belief woven through the material. The present is where our future begins. You apply those hard-won lessons in the moment.
Which keeps fear from paralyzing you.
Absolutely. The investor with a disciplined attitude looks at a 20% market dip not as a disaster, but as a temporary sale on high-quality assets. They see the future even when the present feels, really challenging.
Okay, so we have the direction, which is philosophy, and the emotional regulation, attitude. But as Ron himself taught, knowing and feeling, well, they're not enough.
Not even close. Achievement requires action.
Which leads us to pillar 3, activity. This is where potential finally converts into kinetic energy.
Activity is the consistent application of intelligence and intensity to disciplined actions. In investing, this is the due diligence, the research, the consistent contributions to your portfolio. You can have the best philosophy and a perfect attitude, but if you don't execute, you get nothing.
This demands that you do something with what you have been given, no matter the scale. Whether you're starting with $50 a month or you're moving a huge sum.
The rewards are proportionate to what we actually do.
So what specific activities are we talking about here for a disciplined investor?
It goes way beyond just clicking the buy button. Disciplined activity, it means setting up automated transfers for dollar cost averaging. It means committing to quarterly rebalancing.
Keeping the allocation in check.
Right. It involves the focused effort of reviewing earnings reports. If you're a dividend investor, your activity is vetting balance sheets to make sure those dividends are sustainable, not just chasing a high yield.
So if anyone out there is talking about effortless investing, we're immediately running into what the source material calls the utopia warning.
Precisely. And that warning is critical. Don't get stuck in analysis paralysis. You have to move from theory to reality. The popular term is passive income, but the reality is that passive income requires highly active efforts at the start.
And maintenance throughout.
And consistent maintenance. Effortless investing is a fantasy, a really dangerous one that leads to inertia. Consistent, intelligent activity provides the push.
And that push, that intensity of effort, it takes us directly to pillar 4, results.
The results are the verifiable, measurable harvest from all that effort. And the system guarantees they are always proportionate to the intelligence and intensity of the activity.
But results aren't just the profit and loss statement, are they?
No. The primary function of results in this framework is to act as the feedback loop. The numbers tell you if your philosophy, your attitude, or your activity needs to be modified.
So if you plan for 10% returns and you're only getting 3,
the results force you to ask questions. Do I need to change my capital flow? Do I need to change the investments themselves? Or was my research, my activity just not good enough?
the feedback loop is the engine of self-correction. But the source makes a fascinating shift here. It says the core focus is not just optimizing the portfolio, but on becoming more. What does that mean in financial terms?
This is the attraction principle, but grounded in reality. When Rohn talks about becoming a better person in an investment context, he means becoming more disciplined, more patient, more knowledgeable.
So it's not magic.
Not at all. You're attracting better opportunities because you are prepared to capitalize on them. You're disciplined enough to buy when others are panicking. You're patient enough to hold when others get bored.
So the better person, the disciplined investor, avoids costly mistakes just by being prepared and focused.
Exactly. You elevate your game. And you find yourself interacting with better information, better advisors. You avoid the lazy or reckless advice. Results are improved by increasing your personal value across key disciplines. Self-control, patience, planning, and the wise reinvestment of dividends.
It's all about internal refinement driving external measurable gain.
That's the core of it.
And that progression, from conviction to execution to measurement, brings us to the culmination of the system. Pillar 5, lifestyle.
Lifestyle is the final blending of the first four pieces. It reflects how you choose to live and design your life based on the results you've cultivated.
For an investor, lifestyle is really about independence, right?
Fundamentally, it's the goal of having regular paychecks flowing in from your portfolio, from real estate, whatever, without needing a traditional employer. It's the freedom to design life on your own terms.
And the source reminds us of a crucial distinction here, the art of living richly. We often equate wealth just with a big number,
Net worth, yeah.
but this framework expands that. Living richly means having wealth in health, in time, in virtue, and in calm. You don't have to be a billionaire to live richly.
And the irony is that the disciplined effort required in the first four pillars actually facilitates this rich lifestyle before you even reach the destination. Well, a disciplined investor practices self-control, which is a virtue. They avoid checking market prices constantly, which brings calm. And they use their freed-up mental energy for personal growth, which is a wealth of time.
That's a profound point. The journey of becoming a disciplined investor inherently improves your lifestyle along the way.
It does. The process itself makes you better. If you start with a clear philosophy, maintain a disciplined attitude, apply consistent activity, and get predictable results, the focus shifts entirely.
It moves away from the stressful destination of just getting wealthy.
And toward the rewarding journey of self-development and the freedom you gain along the way.
Okay, let's bring this all together. Let's recap the full loop for you one last time. We established that a strong philosophy, your investment blueprint, must lead to a healthy attitude,
Your emotional control.
which then fuels intelligent activity, your consistent execution. This results in predictable results, your feedback, which culminates in a desired lifestyle.
And here is the actionable takeaway for you, the learner. The system is a continuous loop. If the results you are seeing are unsatisfactory, the framework demands you refine something.
There are no excuses.
None. You must adjust your core philosophy or correct your emotional attitude, or, and this is the most common one, you have to intensify your activity. Every result points to a required change upstream.
So the continuous practice of discipline, patience, and planning is essential to increasing your personal value and becoming that solid, long-term investor.
And these principles apply everywhere. Whether you're aiming for a nomadic life funded by passive income or just progressing in a corporate career, the internal work always pays off.
Which brings us to our final, provocative thought for today. To genuinely have more in your portfolio, to grow your wealth sustainably, we fundamentally have to become more than simple, reaction-driven traders.
We have to become disciplined architects of our own lives and our own financial futures.
So ask yourself this question today. Based on Rohn's 5 pieces, what specific practice, is it planning, self-control, or intensity of effort, will you intensify this week to become a greater human being and therefore a more successful investor all around? That is truly where the results begin.